So we're going to talk about taxes and how taxes relate to finance. Before we get into the investments and taxes, I just wanted to explain that overall there are about 4 types of taxes that people generally pay. Income taxes, as you're all aware, you are paying a portion of your income as tax. Then there are property taxes that people pay, which means that if you own a property, you are going to pay taxes. The third type is HST, or the sales tax. HST is a type of a sales tax that you pay on any item or majority of the items that you purchase. And a fourth type is excise tax, which you pay based on certain items such as gasoline or tobacco. I hope that tax is not being utilized by your age group a lot, but a lot of people are paying it. So these are the 4 types of taxes, generally speaking. Investments and taxes are part of income taxes, because what happens is investments are there to provide some kind of income for you, and those are the taxes that you would pay. Those are it creates income for you, and that's why investments would be linked to income taxes. They can also be obviously corporate taxes, but corporate taxes are also part of those 4 categories: income, property, sales, and excise, because these are generic categories. You can have different forms of structures, meaning individuals, partnerships, or corporations that pay these types of taxes. So let's take a look at today's presentation, which involves investments and taxes. Before we can get into the tax component of investments, we need to differentiate between income and capital, because you are paying taxes on investment income, not on the actual amount of money that you have put in, which is called capital. So you see on this first slide, you have things on the left side and things on the right side that I've itemized. You see on the left side, you have things like Apple, rent, interest, dividends, operating income. But on the right side, you have items such as Apple tree, apartment buildings, savings accounts, stocks, and so on. So on the left side, the items that are on the left side are basically, as you can tell, they are a byproduct of the items on the right side. So if you have an apple tree, you're most likely to get an apple from it, or more than one. If you have an apartment building that you own, you would probably get rent from that. If you have a savings account, you would probably get savings as the income from that. Interest as the income from that. So items on the left are more of a recurring nature. They may be received on a regular basis. Items on the right are more like property, things that you own. These are capital items. Having these may generate items on the left side. So what type of returns from investments are we talking about? There are basically 2 types of returns: income and gain or loss. Now within income, you have various types of incomes. You've got interest, which you can get from savings accounts or GICs or bonds, and you have dividends, which you most likely will get from different types of common shares or preferred shares. And then you have rent, which you may get from real estate property, such as a condo, an apartment building, a house, a commercial property, and so on. And then when you sell the property, whatever kind of property you own, or investment that you own, you may receive a gain or a loss. So the gain or loss only happens upon the sale of a property or sale of an investment. So then, just to summarize again, there are 2 types of returns from investments. You've got the income component and you've got the gain or loss component. They're all taxed in a very different fashion. If you look at the bottom of the slide, you see that I've mentioned the highest personal tax rates as of 2007. They haven't really changed since then, and they've been constant at this level, at the highest level for a few years now. Tax bracket, income taxes are broken down into brackets in Canada. So you've got 4 different brackets, and this is the highest personal tax bracket, which means if you were to earn above a certain amount of money every year, these years it's around 120. If you were to earn anything above that, that amount that falls into that bracket will be taxed at this level, the highest level. So you can see if it was regular income or simple interest income coming from savings accounts or bonds or GICs, you would have to pay 46% of that in taxes. That's almost half of the income that you earn beyond a certain amount in taxes. However, if you were to take a risk and you were to invest in stocks or mutual funds, which would give you dividends, the government says because you've taken a risk, you've taken a chance, and there's obviously with risk comes high potential return or a loss. The government says that this is going to be taken into account, and dividends will be taxed at a lower rate, which will be 31.3% or around there for these years, the current years. Also, companies, when they are paying when they are paying dividends to their shareholders, they have already paid corporate tax beforehand. So they're paying you dividends from after-tax corporate net income. From after-tax corporate net income. So that means that they have already paid some kind of corporation tax, and you as an individual will not have to pay a huge amount of tax. Capital gains, as you can see, gains or losses, well, gains are really taxed very favorably in Canada. They are taxed at 50% of the rate as the regular income. So 23% is what you would pay on gains. Obviously, you're not going to pay any tax on a loss because you haven't made any money. So let's look through the example that I've created, just so you have an idea of how much tax it actually implies. In this case, in this example, you are making only interest income, and the rate of income or the rate of interest is 4%, and your initial amount of investment is $1,000. So that means you have made $40 from the $1,000 in that year. You're going to pay tax on the $40 based on the fact that it is interest income. You are paying 46.4% tax, which is $18.56. That means that your after-tax money is $21. That actually means that you are only making 2.1% as your after-tax return. You're not making 4%. You see how it goes down to almost 2%, which may not even cover the inflation these days. And if you look at the next example, this is where you're only making dividends, and the dividends are also at 4%, and it's $40 on the $1,000. And here you have made $27.48 based on the 31.3% tax rate, which means that you have made 2.75% after tax rate of return, which is higher than the interest income, but obviously lower than other types of income. Capital gains, let's say if you made 4% gains, you would end up paying $9.28 in taxes, and your after-tax rate of return would be 3.07%, which means that this is the highest amount of return that you have after tax. So gains are taxed favorably in Canada based on these examples and this scenario. So again, just to summarize, there are several types of taxes that we pay, and we have just talked about taxes on investment income, and you've got interest, you've got dividends, and you have capital gains or losses. And interest is taxed at a regular rate. Dividends are taxed at a lesser rate, which is around 31% these days. And you have the gains and losses, which are taxed at the lowest rate out of all them, which is at around 23% at this point. So that was the summary for investments and taxes. Thank you for listening.